So single entity financial statements. So single sorry. I was on mute, so I guess I'm muted. So single entity financial statements. So far we've spoken about a couple of the accounting standards, spent some time a lot on their standards. I'm left with IFRS 16, that is leases, and then IAS 33, earnings per share. So leases and earnings per share. But I want to give you a glimpse today on financial statement preparation, and next week as well on the financial statement preparation, and we'll come to these two standards later on in our discussion. For those of you who want to go ahead, I have covered video already on this on my YouTube channel, and you can check it out. Earnings per share, also I have a video on it on my YouTube channel. I shared a link, or I think we shared a link in the group last week on the various playlists that we have on the channel. So if you check the accounting standard series, there are videos on all of these that you can watch. But like I said, we'll be looking at them later on in class as well. Any questions for me before I go for the day? Maybe you were going over something we did and you didn't understand anything, and you want to ask me about it?
Sir.
Yes, ma'am.
Sir, there are other standards.
Yes.
IS.
Inventory. I'll touch on these standards. IS 8, accounting estimate, change in accounting estimate. I'll touch on these standards as we are entity, they will come up. Then I'll explain them. So I wouldn't do a real class on them, but I'll be talking about them as and when we are doing these things. Are you getting it? Because all you have to know in something like IAS to inventory is that inventory is carried at what? Low of cost and then net realizable value, and some other minor concepts which will come up as we are doing the single entity financial statements. If you're watching live, you comment below with any questions that you have. I'll be answering your questions live as well. Mustafa just asked a question, and I think I already replied that question. So if you're watching live, you can put your questions in the comment box and I'll be answering that as well. So now we want to put the pieces together. We have done the various accounting standards. We've done extract of the income statement, extract of the other comprehensive income, extract of the statement of financial position. But we want to put the pieces together and look at it in a holistic manner and find out how we can prepare the financial statements. Now, according to IAS 1, presentation of financial statements, these are the following financial statements that we are supposed to prepare. The income statement and other comprehensive income. Income statement and other comprehensive income. Then we come to the one in the middle, the statement of changes in equity. Then we come to the statement of financial position, which is traditionally called the balance sheet, and then we come to the cash flow statements. So when we talk about single entity financial statements, these are the four things that we are referring to. Now remember, notes to the accounts at this level, we don't require you to put the notes to the accounts there, like the accounting policies you are using and all that, but that is also part. Notes to the accounts. This is where various disclosures are made, various accounting policies that are used in the preparation and the presentation of the financial statements are also made in it. But at this level, we want to just look at what? The first four. That is the statement, income statement and other comprehensive income, statement of changes in equity, and then the statement of financial position. So like I said, we are going to put all the pieces that we have been working on. IAS 16, IAS 20, IAS 23, IFRS 15, IFRS 5. All of the pieces of the standards we've been working on, we are going to put them in these statements and see how realistic we have been. So two things are going to be happening here. Number one, you are going to be doing revision for the standards, and number 2, you are going to be learning a new thing, that is what? The presentation of the financial statement. So let's begin the journey with the first one, the income statement and other comprehensive income. All right. Now, this is a very simple financial statement. What is the objective of the income statement and other comprehensive income? Why do we prepare the income statement or other comprehensive income? What's the objective? Any ideas? What is the objective for the preparation of this financial statement? What do we stand to gain? What does it measure? The profitability of the organization. Okay, any other? Yes, Elvis?
Financial performance of the entity.
The financial performance of what? The entity. So it measures the profitability of the organization, but putting it all together, it measures what? The financial performance of the organization. How well have we performed in the accounting year under consideration? That is what we look at in the income statement and other comprehensive income. So let's go through the pro forma and let me break them down in that case. So we're going to work with a single cash column here. We bring our revenue. We bring our cost of sales. We less that, and that gives us a gross profit. Once we get a gross profit, we are going to be adding other issues. So, other income will be brought here. Something like rent income received will be brought. If there is any fair value gain on financial assets through P&L, do you remember this under financial instruments? Now remember, it could be either a gain or what? A loss. If it is a gain, we add. If it is a loss, what do? You deduct. Does it make sense?
Yeah.
So, fair value gain or loss on the financial instrument through P&L. Then any investment income that we receive will also be brought here. Then any other income item that may be in the question will also be brought. So when we add all of these items up, that gives us the total what? Income. The total income. Once we get the total income for the year, we are going to be dealing with the issue about the expenses. At this level, we're going to have distribution expenses. Sometimes it could be selling and distribution. Admin expenses. When we less that, we are going to get the profit before interest and tax. Then we bring the interest. We less that, we get a profit before tax. Right after that, we're going to be lessing what? The income tax. Once we are done with that, we now get what? The profit after tax or the profit for the year. So that is how we deal with the income statement aspects. So that is the first aspect, the income statement. Then we come to the second slide, and that is going to be our other comprehensive income. From our accounting standards treatment, what are the things that comes under other comprehensive income? What are some of the things we bring here? Revaluation surplus, good. So other comprehensive income, revaluation surplus or gain. What else do we bring? In the OCI, other comprehensive income. Fair value gain or loss on what? Financial instrument through OCI. on financial instrument through OCI. If it's a gain, you add. If it's a loss, you deduct it. What else? Do you remember the government grants? No. It's supposed to be here. So maybe let me put it here. The other income item I put here, the government grants, could be here. Are you getting it? The government grant charge for the year comes in the income statement, not in the OCI. Now, remember the last question we solved in IAS 16 called clerk, where there was a revaluation surplus, and I told you that the deferred tax on it must be split into the income statement and then the other comprehensive income. Do you remember that? Do you remember that question? You don't remember, but you should remember. Remember the question we solved on clerk, where there was a revaluation surplus of 330,000 and there was a deferred tax of 76,000. And I told you that the deferred tax has to be split between the income statement and the OCI. Do you remember that?
Yes.
Yo. So deferred tax on what? Revaluation gain has to be brought here, and that's going to be negated because it will be reducing. And then there could be other items that can come in other comprehensive income. Could be other items that can come. So when we add all that to the profit for the year, we get a total of comprehensive income. We get a total comprehensive income. So this is the pro forma for the income statement and other comprehensive income. But this is the sweet spot. This is the sweet spot. The sweet spot is that these things will not just be free for you in the question that you will pick. So these are the things that are going to be happening. Number one, you are likely to do an adjustment to the revenue. Number two, cost of sales, who pay, you do workings for it. Number three, the fair value gain or loss, you may be required to do workings for. Number four, the government grants allocated, you may be doing workings for it. You may be required to adjust the distribution expenses given to you. You may also be required to adjust the administrative expenses. For the interest expense, it's a regular customer, you will be adjusting. Then our favorite one is the income tax. Our favorite one. Then another favorite. This one, Louisa likes it a lot. Revaluation surplus. So we are going to be doing workings for all of these items. So let me break them down for us in relation to how we deal with these things. Revenue. What do you think are some of the things that may cause us to adjust the revenue? Again, I'm going to be referring to the standards here. Do you remember what we did under financial instruments? Where I told you that an entity sells an entity sells goods with an option to repurchase. Did you remember that statement? What did we say was that? Financial. No, we use the word financial arrangement. And it's a financial what? Liability. So if the entity has included the sales in their revenue, we preparing the income statement and OCI, what do? We take it out. Then when we take it out, we will now recognize it as what? A liability on the face of the statement of financial position. Nemo, there will always be interest on it. So that interest will be charged and will take into as well in the what? Financial statement. So that is the first adjustment that can be done on your revenue figure, where the entity sells goods with an option to repurchase. Please note, sale of goods with an option to repurchase is not a sale, but what? A financial arrangement. So if the entity, and I'm reading this into only a share revenue more, you the professional accountant, you have to reverse it and do the right thing for them. So first adjustment is sales with repurchase option. Another adjustment that can be here in relation to this is under IFRS 15. Revenue from contracts with what? Customers. Do you remember revenue at a revenue over IFRS 15? Do you remember revenue at a revenue over? Missy a revision. It is a more like a Now, so this is what happens. Let's say an entity sells goods with a continuing services cost or with continuing service agreement. And the entity recognizes the whole thing as what? The revenue for the year. You know they've done a mistake, right? So we must take out the continuing service cost because that will be recognized over what? The period. So another adjustment that could come on our revenue figure is when the entity sell a good under what? IFRS 15, and we are recognizing revenue over what? The useful life of the contract. So that is another adjustment that can come on our revenue. Third one is the favorite one. Sale with return option. In other words, the entity sell the goods and they say, oh, at the end of the year, if you cannot use it or if it is not a good thing for you, bring it back. It is called sales returns. Or it's a wholesale and they sell the goods out to retailers. So they said at the end of the year, if you have not sold the goods, bring it back to us. When the entities make the sales, they will include it in their what? Revenue. But when the goods are on sales and return, it means at the end of the year it must what? Be brought. Now, when that stock is brought, what do we do? What's the double entry for that? Who can help me out? When that goods is brought back, we've sold it, then they are returning it. What do we do? What's the double entry? We debit revenue, credit cash. Cash is wrong. It's goods. So what do? You debit revenue and credit stock. So your revenue, that sales is not a sale, isn't it? So that figure must be deducted from what? Our revenue. But the goods that we've received has to be added back to what? The closing inventory. I hope you are getting it. So these are closing inventory, yeah. So closing inventory. Do you understand?
Yes. But look at it.
No, it will be, you see, this one is you have sold a thing on credit. So initially when you were selling, you debited the debtors account. Do you get it? And you credited your revenue. This is the initial sales. Now, if it's returning the goods, you are going to be debiting your revenue account to bring it out. And then you are going to also credit what? The debtors account to bring it out. Then this is what you do again. You are going to be debiting your cost of sales. You debit your inventory, and then you credit what? Your cost of sales. Indeed. Now, why are you crediting cost of sales? Because when you sold it, it has been included in what? Cost of sales. So you must what? Take it out from the cost of sales. So if you want double entry on that, that's how it's going to be. But the technical thing now is that deduct it from the revenue, add it to the what? Closing stock. So these are some of the adjustments that in the footnotes the examiner may require us to do on the revenue figure. So it's question based, not a done deal. Then we come to cost of sales. In KG2 we did this one. In KG2, how did we do cost of sales? Opening stock. Is it that KG2 thing? We don't think the examiner will take you there, but who knows? Add it as it. purchases. Then I will add, somebody said add carriage on purchases. Less purchases what? Returns from it. Then you add this to this, you get what is called cost of goods available for sale. Then you now less closing stock. And you will get what? Cost of sales. But this is the sweet spot. In the exam, or the examiner may not take you to KG2 class like this, so he will just give you the cost of sales in the trial balance. But if he gives you the cost of sales in the trial balance, there is a workings you must do called depreciation all the time. Sometimes depreciation are allocated between what? Cost of sales and then distribution and then admin. So the examiner will tell you how the depreciation should be what? Allocated. But please note that depreciation on plants and equipment usually always come under what? Cost of sales. Depreciation on plants and equipment usually always comes under cost of sales. So you're going to be bringing your depreciation, and then that will give you your total cost of sales. So with cost of sales, that is the adjustment that we'll be doing for our cost of sales in relation to that. So that's the second item. That's the second item. Rent income will be directly stated in the question. Fair value gain or loss on financial asset through P&L, you don't have to think much about it. They will just tell you that in the footnote, they will tell you financial instrument is now this figure. You just compare that to what is in the trial balance. Then you determine whether it is a gain or a loss. So with financial fair value gain on financial asset through P&L, you don't have to think about that very much. You just go straight to that. If there is government grants in the question, how did we say government grants should be accounted for? How did we say government grants should be accounted for? Come on now, it's revision.
Should be amortized to the number of years that the assets.
Okay, so government grants are recognized as what? Deferred income. I get the idea, and then amortized or spread over the economic useful life of the asset. So if a company receives a grant and they include it in their revenue, what do? You take it out. Are you getting it? So you take it out from their revenue and you account for it in accordance with the way it has to be accounted for. Next one. Distribution and admin, I'm not going to talk too much about it because it will be directly in the question and how we are supposed to treat it, but definitely we'll be doing adjustment to them. They will be given to us in the trial balance and we'll pick them up. But I feel that bro never shall say. Interest. The interest that is going to be coming in the income statement entails a number of things. The interest there, I have given you one already. Interest on what? Sale with a repurchase option. That is a financial arrangement. So the interest on that money will be coming here. Maybe we took a bank overdraft or bank loan. Abala. Miss Dream last stop. Okay, so the interest here is interest on bank loan, interest on sale with repurchase option, interest on what? Financial instruments. Okay, so be careful about these treatments in relation to that. Then also, we've not done leases though. We've not done leases, but if there is a lease there is a finance cost aspect of the lease, and that is also supposed to be brought in the interest aspect, IFRS 16, but we'll talk about those things later on. Then to my personal income tax. It is one of the done deal workings that will be in the exam hall. When we are solving this question, I'm going to be doing it for you so you understand how sweet and simple it is. But how do we treat issues in relation to under or over provision of tax? Revision. If in the trial balance The examiner writes, no say profile flip because often him say me can no answer. Shame. In trial balance, you see over or under provision of tax, and it's on the debit side. What does it mean? In the trial balance, you see over or under provision of tax, and it's on the debit side. What does it mean? Is it over provision of tax or under provision of tax? Where true or false? Since you come and you back, is what? Is what? People don't have them crowd. Rudolph, what do you think? It's over provision. When over and under is on the debit side. What's it then? Where true or false? No. Main guys are with you. Everyone wants tea, everyone's with tea, but me the main kind. Louisa, what do you think? Gloria. Over provision. When over or under is on the debit side. Let's vote. Over provision of tax, raise your hand. Your left hand, you are writing, so you can raise your left hand. Okay. Okay. Who's here over chocolate about class when you bring it? Who's here over chocolate? Over provision, raise your hand. Okay. 1, 2, 3, 4, 5, 6, 7, 8. Okay. Just a moment now, one can under provision. And then over to chocolate 2 bucks at check class because oh my boy. Yes, what do you think? Okran, what do you think? Oh, you said over. Yeah. Elvis, you also supported over. It's under provision of tax or over provision of tax. It's over provision of tax, so it is an asset to the organization. So the rest of you, why didn't you know? How many of you took Lotto? Like, this guy is real, bro. You stake Lotto, straight up. But if it's on the debit side, it means that it is what? Over provision of tax. So it will reduce our what? Tax liability. If it is on the credit side, it means what? Under provision of tax, so it will increase our tax liability. Does it make sense? And one key statement I also made is this. When you are preparing the income tax account, whichever side that the over or under is on, that is the same side you will bring it on in the tax account. So if it's on the debit side, you pick it up and bring it to the debit side of what? The tax account. If it's on the credit side, you pick it up and take it to the credit side of the tax account. Very simple, sweet, straight to the point. Any question? Then revaluation surplus or gain will be IAS 16, which you know about it already. So I'm not going to be going into that. Any question, please? Any question on the pro forma? Okay. Silence means 2 things: neutral or yentase. The next one: statement of changes in equity. So I'm going to use that, put that here. Then we'll go to our question real quick. Now, in the statement of changes in equity, a number of things come in that we need to take care of. Traditionally, we're going to have share capital and his brother share premium, and then retained earnings, and then revaluation surplus or reserve, and then total. So this is the things that we cover in the statement of changes in equity. We always start with the opening balance. So balance brought forward. Now these ones will be given to us in the trial balance, okay? So you just bring it up, you don't have to think. 3 marks. Then you add all, and the all goes under the total. I didn't bring currency column, but I didn't bring currencies, but don't have currencies there. Follow me carefully here. Prior period adjustment. If previously the entity made any error, then now we have found the error will be adjusted under what? Retained earnings. So if, for instance, listen carefully, an entity had capitalized an expenses that they should have written off, what will be the effect on that on the profit? An entity had capitalized an expenses that they are supposed to have written off. What will be the effect of that on the retained earnings? The retained earnings will go up because they have overstated what? Profit and understated their expenses. So now, if you identify the error, what do you come and do? You deduct it. These items are what we refer to as prior period what? Adjustments. So if the entity made any error, and per chance we are now identifying the error, then we adjust it in the retained earnings. If, for instance, they receive a government grant and they did not account for it the way it's supposed to be accounted for, then quickly we must readjust it in the retained earnings. So that is what we mean by PPA, prior period adjustments. Then we come to the profit for the year. Now, this figure here, profit after tax. Please note, the total comprehensive income never comes in the statement of changes in equity. The only thing that comes in the statement of changes in equity is what? This one. So when we say profit for the year, we mean profit after tax. Where does it go? Retained earnings. Now, I'm writing profit for the year as though the company will only make profits. If they made a loss too, you are supposed to what? Deduct it. Okay?
So we're going to profit or loss.
So profit or loss. For the year. Good evening. So if it's a loss, we deduct. If it's a profit, we add. Then next one. You remember OCI, the revaluation surplus or gain. So if there's a revaluation surplus, it goes under what? You got it. Then, if the entity issued shares during the year, so issue of shares, it comes under what? The share capital. But please note, if the entity issues the shares and made a profit, then the profit goes where? Share premium. So you have share premium as well of that. Now, how do we split it? So if the nominal value of the share is $2 and the share was issued at 2 goes to the share capital, the share premium. You got it. So the 2 will be added up for the total column. Then dividend. If during the year the entity paid any dividend, that one will also be deducted from what? Retained earnings. So we take it out as well in the retained earnings. These are some of the things that we talk about under the statement of changes in equity. There could be other specific items, but close it up here. So this gives us the balance brought down, or if you want balance carry forward. And these figures are what goes into the statement of financial position under what? Equity. In this only who are take balance sheet also take. So you make sure that you get a concept very well about this. This is also the statement of changes in equity. So income statement and other comprehensive income, statement of changes in equity. Any question? Any question? Yes, I know. Sorry.
Question.
Yes.
The surplus. Won't you add it to the total?
It has to. Did I put that there? Yeah. Thank you. Okay, so online I see some questions there. Let me answer that. Eric Nano, please explain how deferred tax on revaluation of assets should be less in the other comprehensive income. But you've already answered yourself. Deferred tax is less. Should be less. How? Maybe clarify your question for me. Deferred tax on revaluation is always less from the OCI, and you've already stated that. So maybe clarify your question for me much better. Samuel Quincy. Okay. Hi there. Hi there. We are here.
As they are copying it, I would like to ask a question on the grant.
Okay.
Yes, it does not mean that you are going to spread it within the useful life
Of the assets.
Maybe that amount which seemed for the exact year you are preparing a report for will be placed back when they are saying you are taking it out of.
Yes. So assuming they recognize the grant as a revenue figure, so we take it from the revenue and rather spread it over the useful life of the assets.
Okay.
Are you getting it?
Yeah.
But one sweet thing you must also understand about grants is that grants could also be received in relation to employment of people. So the government can say, if the entity employs graduates, then every year the entity will give, the government will give the entity maybe $1,000 every year. For that, we don't treat it as the normal grant, We will just net it off against what? The employee expenses. So if we pay the employees $100,000 and the government gives us a grant of $20,000, we just use that to reduce the employee salary, and then the $80,000 is what will be taken there. So grants on employees, that one we don't defer it. We just account for it and net it off with a figure there. So you go to page 29 if you are good, or page 28. Quincy, my baby. And I want about Bugaba. Let me see if we'll get a copy for you.
The dividend case,
Yeah?
they want the figure that it will have follow. It should be like that.
Yes, sir. So where is the party you organized?
I was expecting
Question.
Yeah.
The issue of shares.
Yes.
Let's say if the original share was supposed to go for $2,
Yeah.
but that share was bought for 1.5.
All right.
So the difference will it go to the share premium?
It will still be deducted from the share premium if we already have some share premium outstanding. If we don't have any share premium outstanding, it could be written off as an expenses in the year. But if we have a share premium outstanding, we will take it out. But usually, in the exam scenario, hardly do we have that scenario. Even in practice, hardly will we sell the shares below its nominal value. Everybody done? Can we go? So I want you to pay close attention to me. You're going to stop writing. We're going to do all the workings on the board. Then I leave you to write because I need you to really understand what we are doing very well. In this question for Quincy, thematically, there are 4 accounting standards in place. There is IFRS 15 there, revenue from contract with customers. There is IFRS 9 there, financial instruments. There is IAS 16 there, property, plant, and equipment. And then IAS 12, income tax. So these are the 4 accounting standards present in this question. So we're going to see how the footnotes will be going. Now, the way I deal with single entity is to go to the footnote, read the footnote one after the other, and do the workings like that. And I recommend you to do same. Don't read the whole question before you start. By the time you finish reading the whole question, you don't even know what to do. So you're going to read the footnote one after the other. And as you read, you do your workings. As you read, you do your workings till you finish with what? All the footnotes. So that is what I recommend you to do, and it's going to be helping us. Now, for those of you watching online, you can send me a message on Skype, Premium Educator, that is my ID, and you can get access to the questions so you can refer to for what we are solving.
What's the phone number of VP?
Prior period adjustment. Adobe Reader. You do your work. Or we should give it to PDF.
It's his birthday, sir.
It's PDF birthday.
Yes, I include
You ready?
On the 1st of October 2011.
Go.
Note 1. On the 1st of October 2011, Quincy sold one of its products for $10 million.
Okay, pause. Just go to the preamble of the question for me before you go to the footnote. What's the preamble there? The
following trial balance relates to Quincy as at 30th September 2012.
Good. So we've been given the trial balance for 30th September 2012. Then go to the requirements of the question as well.
Require A. Prepare the statement of comprehensive income for Quincy for the year ended 30th September 2012.
Okay.
B. Prepare the statement of changes in equity for Quincy for the year ended 30th September 2012.
And then?
Prepare the statement of financial position for Quincy as at 30th September 2012.
You got it. So we know that the year ended for the company is 30th September 2012. Very, very important to understand that, so that as we read our footnotes, we'll be able to build our what? Understanding. So let's go to note 1. Go.
On 1st October 2011.
When is 1st October 2011? When is 1st October 2011? The beginning of the year. So go.
On 1st October 2011, Quincy sold one of its products for $10 million, included in revenue in the trial balance.
Please. The company sold goods for $10 million, and that $10 million is included in their what? Revenue. So go back to the trial balance. You will see revenue, there is note 1 attached to it. Have you seen that?
Yeah.
Good. Go back.
As part of the sale agreement, Quincy is committed to the ongoing servicing of this product until 30th September 2014. That is 3 years from the date of sale.
Pause. What comes to your mind if you read an English like this? The company sells, and the company is committed to an ongoing service of the product till 20S4, which is 3 years from now. An English like that, what comes to your mind?
That the service is not completed, therefore you can't realize profit. You can't realize the revenue as a full and complete that.
Okay. So there is still a service to be done. So this note here is on IFRS what? 15. So it means the continuing service must be deferred. Are you getting the idea? and not included in the revenue for the year. Because remember, the whole 10 million, which includes the continuing service, is included in the revenue. So we must take it out from what? The revenue, and then now defer the continuing service. Go.
The value of this service has been included in the selling price of $10 million.
Pause. So we have 3 years continuing service from the date of the sale. Now, when did we do the sale? The start of the year, isn't it?
Yes.
Will you agree with me that we've done 1 year of the service?
Yes.
So we are left with 2 years to go?
Yes.
Good. Go.
The estimated cost to Quincy of the servicing is $600,000 per annum.
All right.
And Quincy's normal gross profit margin on this type of servicing is 25%.
All right.
Ignore discounting.
All right. So what are we supposed to do here? Under IFRS 15, revenue shall be recognized at and revenue shall be recognized over. The whole 10 million has been included in the revenue of the company. So we must take the parts that will be recognized over the period of what? 2 years. So the question is, how do we go about that? So note 1, service cost. Per annum is how much? $600. Now we want to tell the examiner that we are working in what? Thousands. So how much will be the total? So the total service cost will be 600 times it 2, and that will give us 1,200. Does it make sense? Are you done? No. Go back to the question. The examiner said Quincy's normal gross profit margin on this type of servicing is what? 25%. So it means that this is not the total revenue. This revenue here is the cost. So we need to get a total revenue of this service. So the concept we are going to be applying is that the entire revenue for this 2 year servicing cost is 100%, and we don't know that. And this 1,002 here, madam,
Why 2 years?
why?
2 years. It's 3 years.
Yes, but the servicing cost, we've done 1 year already.
Okay, so we are looking for the.
We are looking for only the 2 years deferred. Ogran, are you okay?
Yes.
All right. So what are we saying? The total revenue in the service, we don't know. That is the X. But this 1,002, will you agree to me that with me that it represents 75% of the cost?
Yes.
Will you agree with me that that is 75% because the margin is 25%? So this 1,002 represents the cost. Is the cost, and that cost is 75%. So if we want the service cost that will be deferred, that is going to be 1,200 times what? 100 over 75. What do I have? Please, do you understand? If you don't understand, you ask your question. You don't understand? Hey, who had the whole show? How? Okay, so let's build our understanding. Let's go. The entity has sold a good or goods, and as part of the goods, they will be doing continuing services. The continuing services is where our headache is. The whole sales proceeds of $10 million is already included in the revenue. But because of the continuing service, that revenue from the continuing service should be recognized over the period of what? 3 years. But as part of the continuing service, because they sold the goods at the beginning of the year and we are at the end of the year, it means they've done 1 year already. So the continuing service, Acca how many years? 2 years. For that 2 years, the examiner is telling us that the cost of the service is $600,000 every year. So the 2 years will be what? 1,002. But the examiner is saying that the margin that the company makes on the continuing service is 25%. So the question is, what then is the total revenue from the service cost? To get a total revenue from the service cost, it means the cost we are incurring for the service represents what? 75%, and the total cost we don't know, or the total revenue we don't know, so we have to calculate that. Any question, please? Do you understand? Or you are wondering why the 25% is not appearing anywhere? Is that what you are wondering? Anybody wondering like that? So the cost represents, so this is the idea. The cost represents 75%. So how do we get a total revenue? That's all. So the total revenue is 100%. So what do I have for this? 1,600. But what did we say? This must be splitted into two. Yes, the whole amount is a deferred income under current liabilities, but it must be splitted into what? Non-current liability and what? Current liability. Because it is per annum, we split this figure into two. So $800 will go into non-current liability, $800 will go to what? Current liability. Do you understand? So this 600, 1,006 is the only thing we will deduct from the revenue figure.
Boss, you are looking for the total revenue. So how does it then become a liability?
But servicing cost, when you have money, so it's a deferred income, and deferred income is what? A liability. Do you get it? So what do we deduct from revenue? 1,006. So if I want to do workings 2, I'm looking for revenue. I will say per trial balance. What is the revenue in the trial balance?
213,500.
Then we will less what? The deferred income. Of how much? 1,600. That's it. That's it. So that is note 1. Note 1. Go to note 2. Like I said, stay with me. When I finish, you're going to be writing.
Quincy issued a $25 million 6% loan note on 1st October 2011.
Okay.
Issue costs were $1 million, and these have been charged to administrative expenses.
Pause. What do you think the company has done? They have issued a loan note, and the issue cost has been charged to admin expenses. Is it the right thing to do? What do we do to the issue cost? What do we do to the issue cost? We less it from the 25 million. So it means quickly, workings 3, we are going to take what? The admin expenses and adjust it as soon as possible. 3. You good? This is 2. So this will be 3. Per trial balance, please give me the admin expenses.
19,000.
19,000. So we will less the issue cost. How much is the issue cost? Which is 1,000. I don't need the closing balance because you have to keep this thing open. Workings 4. Let's deal with the loan notes. What is the proceeds we had? 25,000. So we will now come and less what? The issue cost, which is how much? 1 million. And so now the fair value of the loan notes will be what? 24,000. So when you read the question, quickly know what is happening in the question. They have issued a loan note. Issue cost is not supposed to be included here. So quickly, you go and deduct it, and quickly, you deduct it as well from what? The loan note. Go.
The loan will be redeemed on 30th September 2014 at a premium, which gives an effective interest rate on the loan of 8%.
Okay. Do you remember how we deal with effective rates and coupon rates? Tell me about it. How do we deal with effective rates and coupon rates? Financial instruments, last week. What do we do? We add the effective interest rates and we deduct the coupon rate. Which one goes to the income statement? The effective rate. Give that in. So, interest payable. The interest payable will be at what? The effective rate. What is the effective rate?
8%.
8%. So give me 8% on this figure. 920. Then the interest that the company actually paid is the coupon rate at how much? 6%. What do we have? 1440. So we take it out, and this becomes the carry value of what? The loan notes. Do you know what I just did? That thing we did here is what I have represented here. So I could have brought here, balance brought forward, interest, payments, and carry forward. And then I'm year one, you know we bring this figure, 24,000. Then interest will be what? The effective rate, 1920. Payment will be on the coupon rate. Did you do this on the coupon rate?
No.
1,500.
Is what?
1,500.
You did this on this, right? Where do you go? Always the interest we pay, the coupon rate will be on the nominal value. But the effective rate will be on the what? Fair value. I hope you are getting the trick. So 1,500. Until I don't ever have. Now I tear free, then we get a carry forward. How much? Can I have an answer, please? 24,420. So this goes to the statement of financial position under what? Non-current liability. That's the carry forward. So this horizontal thing is what I represented what? Vertically. So now this interest payable goes where? To the income statement. So I can put across another workings for interest expense. You see how easy this thing is going? Yeah, it's not easy. Your big head. So interest on financial instruments from workings 4. How much? 1920. That's what goes to the income statement. Mommy.
So the issue cost.
Yeah.
Note 4 and 3.
Note 4 and 3.
Subtract the issue cost from the.
Admin expense, yeah.
And you also subtracted it from the loan notes. When we're doing financial instrument, you said if the financial instrument is for a strategic objective.
That is financial assets.
Assets.
This is a financial liability. The entity issued a loan note. So I have no yen dealing with short term or long term. It is when we buy, assuming the entity was the one who bought this, then it will be a financial asset.
So in this case that we have subtracted from both figures, how are we going to treat the issue cost? Well,
We've treated it. We've deducted. You see, they have added it to expenses, which will reduce our profits. But that is not what they are supposed to do. They are supposed to rather subtract it from the proceeds. That's why we are taking it out from the admin spend. So it's not like we are doing double deduction. This is an error. So we are correcting the error, and this is the right thing that has to be done. Does that make sense? Now this is the double entry. If you want double entry for this is it. It's debiting the liability and crediting what? The admin expense. You know admin expense has a debit balance. When you credit it, what do? You subtract it. And when you debit the loan note also keeps a credit balance. So when you debit it, it means you are what? Deducting. So this is the double entry. So don't see it like double deduction, but it's the double entry that we are just using there. Don't say the F already. Here we go. That's note 2. So go to note 3.
Quincy pays and
So 2 notes are given as 5.
Don't think like that now. If you think like that, you say the work chow. But if you think like that, you say the work chow. I don't want you to think like that.
Yes,
Just think that is the solution to the question. Let's go, Adobe Reader.
Quincy paid an equity dividend of 8 cents per share during the year ended 30th September 2012.
Okay. So they paid a dividend of what? 8 cents. So how do we go about this? Look at it. It means first we need to know the number of equity shares. So go to the trial balance and tell me about the equities of the company. What is the equity of the company like? 25 at what? 60,000, isn't it? So to get a number of shares, we would divide the value there over what? 0.25. What do I have?
240,000.
So the number of shares is 240,000. So now we can get a dividend that the company was paid. And that is equal to what? 240,000 times 8 cents, isn't it? That's 0.08. Not 80 cents or 8, so 0.08. Can I have an answer?
19,200.
19,200. Where does this go? Statement of changes in equity from the retained what? Earnings. And no, notices. Go to the trial balance and let me show you something there. You will see loan interest and dividend paid in the trial balance. Can you see that? How much is there?
27,000.
Can you see that? 20,000. So it is this 1,005 and then what? This 19,200. Do you understand? So the loan interest paid 1,005 plus the dividend paid 19,200. That is what gave you the 20,000 what? 700. Why did I bring your knowledge to that? Because assuming they hadn't paid all the 1,005, then the Acca will be taken to current liability in the statement of financial position. Does it make sense?
Can you please repeat?
Assuming they hadn't paid this 1,005, all of them, what will be remaining will be taken to what? Current liability in the statement of financial position. But in this question, they've paid that along with what? The dividend. So that it won't go to the statement of financial position. Jose, are you okay?
So if the figure there is not up to the sum of this and that, how do you know that it was part of this that was paid and then the remaining will go?
That's a nice question. In that case, the examiner will clarify them as a separate item, not put them together. Yes. So the examiner will clarify that loan interest paid is maybe 1,002, and the rest is what? Dividend. So in that case, you know they are supposed to pay 1,005. But if they pay 1,002, that means you are left with what? 300. And that 300 will go to the statement of financial position and the current liability.
So can it also be silent?
No, it cannot be silent. They will always talk about it. They will always say something about it. Next one.
Non-current assets.
Okay, this is the fun part. This one requires a lot of space. So,
That's right.
right, and then let's continue. Eric Nano. Amponsa Augustine. Fantastic topic. Okay, thank you. Then Eric Nano, you said, Nhyira, kindly share the question. What are you looking for?
First one.
Service costs.
You go.
Nhyira has to go to writing school, don't worry. Service. I should get my first copy. Okay. Now, Eric Nano, you are asking about a question. Send me hi on Skype. Nhyira Premium. Premium Educator. Then it will be sent to you via Skype. And the beginning soon will be.
The 600.
Per annum. Gloria, when I saw my first copy book money. What's the way we could journal send me to a best time? But who got time? I can't say when they come over. So per annum is this total service cost. Yep.
So what if after we have 2 remaining years and then we spread it?
Yeah.
What do we have? Sorry, we take 1/3 of it as current value.
I don't understand.
With the deferred revenue,
Yeah.
we had 1,600 and then we had 2 years remaining. So we split it into 2.
Yeah.
And one as non-current, one as current.
Yeah.
What if we had 3 remaining years?
Yeah, if we have 3 years and it is always per annum, so we divide it still into 3. Then 1 year will be current, then the 2 years will go to non-current.
So after getting the 1,006 in the exam, you have to do it like this.
Which 1,000 cedis?
The 1,600 for the deferred cost.
Yeah. No, this thing, I am doing it in class, but you have to know that this is what has to happen in the statement of financial position.
Nhyira. First one, I still don't get it.
Okay.
What do they mean by normal gross profit margin? What does it mean on this type of services? Normal gross profit margin.
It means that the service that they are undertaking is not free. The cost that they incur in undertaking the service, they have to make some money on it. No entity does free service. So even though they will tell you, we are doing it for you for free, the cost has been, the profit has been embedded in the revenue that they are taking from you. Do you get the concept? So the normal profit that they make on such services is the 25%. But the cost they incur is what? 600. But you see, the examiner has given you costs, but you have margin. So another way to look at this is the movement from what? The margin back to markup to be able to get the revenue in relation to that. Does it make sense now? Or it still doesn't make sense?
So the 600
is the service cost.
is the cost, but it doesn't include the profit that they will make.
No. But then on such services, they make a margin. Assuming they have said markup, they would have just done 25% of the 1,002 and add it back to the 1,002, then we'll get a revenue. Are you getting the idea? But they didn't say markup, they said profit margin. And margin is on the sales, which is the revenue. That's why the total revenue is not known. And the 1,002 represents 75%. So that we will now calculate what? The total revenue. You get it now? Can we go? Everybody good?
You are not done.
Yo. Are we done now? So let's go to the notes. Ebazi. 4, right?
Yes.
That's on non-current asset. Actually, I wish I could even allow you to solve this note. Because it's IAS 16 and you can solve it. You said what? Charlie. I can't wait, Okay, let's go.
Quincy had been carrying land and buildings at depreciated cost.
Alright.
But due to a recent rise in property prices, it decided to revalue its property on 1st October 2011 to market.
When is 1st October 2011?
The beginning of the year.
So the company is doing the revaluation at the start of the year. Okay, pause before you continue. If there is any fair value, revaluation surplus or gain, how will it be treated? If there is any revaluation surplus or gain, how will it be treated? If there is any revaluation surplus or gain, how will it be treated?
To be treated as OCI.
will be treated as well.
OCI.
OCI and what? Double entry. Give me double entry. Debit what? PPE, yeah. Assets, credit what? Revaluation surplus and then OCI, isn't it? If the entity is making a transfer, if the revaluation has been done at the start of the year, will we start the transfer for the current year under consideration, or we will start the transfer in the following year? Let me take that again. If the entity is making transfer and they are revaluing the assets at the start of the year, do we do the transfer for the current year ended, or we start from the next year? Current year, why? Next year, why?
The revaluation was done here at the beginning of the year.
So why would we do the transfer for current year? Gloria, what do you think?
Because the revalued
Surplus.
yes, the assets will be depreciated over the, we will use the new value.
Okay,
depreciation.
good. So the asset will be depreciated at the what? Revalued amount. For that reason, more depreciation would have been charged than what? Than what would you have charged. So because the revaluation is done at the beginning of the year, quickly we must do transfer for what? This year, not starting from next year. It is when revaluation is done at the end of the year that we don't start the transfer in the current year, but rather in what? The next accounting year. Does it make sense? So immediately you read the language, you must understand quickly. If this doesn't play in your mind, that means overdrink. And I mean person overdrink. Let's go.
An independent valuer confirmed the value of the property at $60 million. Land elements, $12 million. As at that date, and the directors accepted this valuation. The property had a remaining life of 16 years at the date of its revaluation. Quincy will make a transfer from the revaluation reserve to retained earnings in respect of the realization of the revaluation reserve. Ignore deferred tax on the revaluation.
Okay. What do you see here? The examiner said we should ignore deferred tax on the revaluation. Remember the question we solved in Clark? When there's a revaluation gain, you charge deferred tax as well in what? OCI. But the examiner is saying here that we should not treat what? Deferred tax. 2. The examiner says we should do transfer because of what? The revaluation gain. So let's put the pieces together. Land, building, total. Can I have the cost respectively? So go to the trial balance. Land and building. That's the total, right? Land is 10,000. So building is 40,000. Give me the accumulated depreciation. Land is not depreciated, but building has an accumulated depreciation of 8,000. So we take it out. Take it out. So carrying value as at 1st October 2011 will be still 10,000. 32,000, giving us a total of. Then the assets were revalued. So revalued amount on that same date, 1st October 2011. What do we have? 60,000 in total. Land woman,
12,000.
and the building is, so you did that, 48,000. What are we seeing here? The balancing figure will be revaluation or surplus. So this will be 16,000, giving us a total of 18,000. Now this gain, how do you treat it? How do you treat the gain? Revaluation what? Gain, and then what? OCI. But we need to calculate the depreciation for the current year. So depreciation for the year ended 30th September 2012. We will depreciate land. The building, what is the useful life now?
16.
So 48,000 over 16. What do we have? 3,000. So you take it out. Take it out. So this will be the carry forward. 45,000. So 57,000. Are we done? No. The examiner said we should do transfer in relation to what? The revaluation. Is the transfer done on the total 18,000 or done only on the building? Is the transfer done on the total revaluation gain or on just the building component? Is the transfer done on the total or the building? Okay. It's true or false? It's a lie. We do it only on what? The building component. Did you depreciate the land? No. So the only component that will cause us to lose money, that will cause the shareholders' figure to reduce, is what we do the transfer on. So even though the whole surplus is 18,000, you do the transfer on only what? The building part. Very, very important. So transfer. That will be 16,000 over us. 16. And that will give us 1,000. How do you deal with this 1,000? You debit revaluation surplus and credit what? Retained earnings. And money. Yeah, with the first part of the note 4.
How many parts more?
Continue with the note for us. What does it say?
Plant and equipment is depreciated at 15% per annum.
Good.
Using the reducing balance method.
Okay, so this is my working 7. So plant and what? Equipment. So give me the cost of plant and equipment. What is the cost from the trial balance?
83.
53. 83, 700. Accumulated dip. 33, 700. Carrying value as at 1st October 2011. What do we have? 50,000. So the depreciation for the year 30th September 2012. What we got? At what rate? 15%. So 15% on that is on reducing balance basis. 7K. All right. So give me carrying value as at 30th September 2012. What do we have? 42,500. Are we done with the note 4?
Yes.
No.
There's a final statement there. What does it say?
No depreciation has yet been charged on any non-current assets for the year ended 30th September 2012.
And then?
All depreciation is charged to cost of sales.
Boom! The examiner has said it. He said all depreciation should go to cost of sales. So quickly, I do workings 8, cost of sales. Question back. Yes, I'm saying, sir. The pain on you, baby. Let me there for me, pain. No. This is the thing. If you know it, you will use less time to do this. Frankly speaking, if you know, you read and you know what you are doing, you use like 25 minutes to do this. I tell you. And Nutina, you must understand the standards. Again, you know everything here is a standard. IAS 16. Yes, It is already now for now. Hey, everybody. Annual transfer, no anything. Nhyira said it too. Oh, hey. Time now, so that is the thing. Per trial balance, give me cost of sales, please.
136,800.
136,800. And the examiner said depreciation should be coming to where? Cost of sales. So let's bring dip on building. And that's coming from working 7, 3,000. And then dip on what? Plant and equipment. That's also working 7, and that is 7,500. We still keep it open. We don't know what will happen. So let's go. That's note 4. Any question, please, on that note? Any question? That's note 4. Okay, let's go. Note 5.
The investments had a fair value of $15.7 million as at 30th September 2012.
Good.
There were no acquisitions or disposals of these investments during the year ended 30th September 2012.
All right. Technically, you're not supposed to really do workings for this because go to the trial balance. What is the investment value at the beginning of the year? The equity investment.
60,000.
Are you sure you didn't lie? What?
17,000.
So as at 30th, 1st October 2012, it is what? 17,000. But at the year ended 30th September, sorry, this 2011, 2012, it has gone to what? 15,700. What's happening here? So fair value loss. What do I get? 1,300. Where does it go? Why did you lie?
Say sorry.
How do you know that this should be a long term or a short term? What shows it? There is nothing in the question that tells us that. So I told you that there is nothing, we go to the default approach.
Yeah.
So this will go to where? P&L. You get a concept? Financial instruments. Sweet. Tina time, no, and I standards me, no. We are cruising. This won't mean cruising. Next question, you will cruise. So let's go. Next note.
The balance on current tax represents.
I love that. So that's our last working, and that's going to be what? Income tax. Where regular customer managing country more here. Maybe. So quickly, let me open it up, and then we'll read the English. Then we go. Go.
The balance on current tax represents the under or over provision of the tax liability for the year ended 30th September 2011.
Pause. So go to the trial balance and look at under or over provision. Where is it at? It's on the debit side. So I told you, whichever side it is, that's the same side you bring it on here. So it's on the debit side, isn't it? That's an over provision. So you bring it to the debit side here. So balance brought forward 1100. Continue.
A provision for income tax for the year ended 30th September 2012 of $7.4 million is required.
Pause. A provision for the current year, 30th September 2012 is what? Required. So quickly we close our accounts nicely, and that's balance brought down on current year tax. What's it, honey?
7.4 million.
7,400. Every brought down must have. Now, in case you're asking what is CY, current year, go. Please, do you understand the treatment? Okay. So the current year provision is a brought down, and it comes a carry down here. Go.
At 30th September 2012, Quincy had taxable temporary differences of $5 million, requiring a provision for deferred tax.
All right.
Any deferred tax adjustment should be reported in the income statement. The income tax rate of Quincy is 20%.
So we have to do deferred tax as well. So the closing deferred tax is what they have given to us. So balance brought down, DT. It is, what is the temporary difference?
5 million.
So 5,000 times what? 20%. What we got?
1,000.
1,000. Then every brought down must have a carry down, DT. 1,000. Then go to the trial balance to see if there is deferred tax opening.
1,000.
Is there?
Yes.
On which side?
Credit.
So balance brought forward, DT, how much? You balance this account. The balancing figure is what will go to the income statement as deferred tax. Do you understand?
Yes, so if assuming the balance was forward for the current year of the
What's it? Kaza.
I'm saying that assuming the balance was forward of the tax was on the credit side and then
Okay.
we put it there, that would mean that the balance was forward would be the balance brought down would be at the
No. It's always
So it's-
going to be great. If it is temporary difference and it's an asset, the examiner will clarify it. But if it's silent, it's always going to be a liability. It doesn't mean this will be here, so this has to be here. And then always note that the current tax provision is always on the credit side as a brought down. So it comes here as what? A carry down. Do you understand it?
So
Now,
so it's the same with the deferred tax as well.
yeah, the defect, but it could be an asset. If it's an asset, then it would have come on the debit side here. But in this question, it is silent because we know it has to be what? A temporary tax liability. That's why it goes to the credit side. So this current year tax goes to current liability. Then the deferred tax goes to what? Non-current liability in the statement of financial position. So balance this account. The balancing figure is what we take to the income statement as the income tax for the year. Definitely the debit side will be bigger. What's the difference?
8,300.
8,300.
No, that's
That's the balancing figure.
Yeah.
So this will be
9,500.
okay. So that is the answer to the question. We are done with the workings. So that is the answer to the question. So please write it down and close all the other accounts. The revenue accounts, you close it. The interest, you close it. Now, I didn't do this. Please, let's go. Now, when you finish with the footnote, you go to the trial balance and see if there is any item there you've not touched, you've not talked about. So let's go through the items briefly. So here, you grab your pen and you'll be working on it. Revenue, we've spoken about it, right? Cost of sales, we just spoke about it. Distribution cost, we've spoken about it. Hey, did we?
No.
There was nothing on it. But remember, when we are preparing the income statement, the distribution cost will come there. Loan interest, we've dealt with that. Admin expense, we've done an adjustment to it, right? So you make sure you close it up. Equity shares, there was no issue of shares, so the same figure will go to the statement of financial position. 6% loan notes. And then I hire new workings, no. So the new workings will rather go to the statement of financial position. Do you remember that?
Yeah.
Retained earnings, statement of changes in equity. Land and building, we have had a new figure. Plant and equipment, accumulated debt, forgetting no. Inventory, current assets. Receivables, current assets. Bank, current assets. Current tax and deferred tax, you've dealt with it here. Trade payable, current liability. So that is it. So when you finish with the workings, you go to the trial balance if there is any item that you've not touched on and you look at the treatment. So this is it. Uche Ijehu, you said I should share the question. Send me hi on Skype at Premium Educator, okay? And the question will be shared with you on Skype. So send me hi, Uche Ijehu. Sorry if I don't mention your name right. So I've put it in the chat. You can see it. Premium Educator. You send me hi on Skype, and the question will be sent to you, so you can get access.
So, the plant and equipment should be working straight.
No, it could be 7 still. So 7 heading will be the non-current assets. So you do the two together. So Eric Nano, I see your message on Skype. So the question has been sent to you, so you can check it out. So if you are done, add the other figures that must be added and close the other accounts. Cost of sales. Because the cost of sales. So you close the cost of sales. I believe you left a space. So add it up to close it. So we get a total. Let's see what it's doing now. Don't think it's a cat.
More businesses charge because of revaluation.
Yeah.
That's the only reason.
Yes. Who has the totals for cost of sales?
147,300.
Okay, so write it down. That's confirmed, right? Yeah, no, they are my bomb. Then the other workings. Which one else do we have? The revenue. Who has done that?
211,900.
211.
900.
900, okay. Everybody done, please? So let's now put the pieces together to the real question. So all these are workings. All these are workings. But now that we are done, you see how easy the financial statements will be prepared. You get a new marker. So, A, the income statement and other comprehensive income for the year ended 30th September 2012. Remember Quincy, the name will be up. You just want to punish me. Quincy Limited. Okay, so let's go. Go to your workings and you're going to feed me. Somebody gives me bump, you say it's bump. Then we go ahead. Revenue. Workings what?
2.
What's that figure?
211,900.
Confirm.
Yes.
Cost of sales. Workings.
8.
How much?
147,300.
Deduct it. We get gross profit. What do we have? Punch for me. Sorry?
64600.
64600. Do we have other income in the question that we are supposed to bring? In the trial balance, were there any income like interest income, dividend, investment income?
Investment income.
There was an investment income.
Yes.
So how much is the investment income?
400.
So we bring it up. $400. What else did we say must come here? The fair value loss. It's not enough doing the workings. It's most important knowing where to bring it. The fair value loss on the financial instrument. Do you remember?
Yeah.
Workings what? What? 9. How much is it? 1,300. Any other item that must come here?
But that's not an income.
No, it has to come after cost of sales. Sorry, after the gross profits. Before we bring the distribution and those guys. Any other income in the question that we must bring? Or that is all? That is all. Okay. Then give me the next figure here. Fastest one, please. 63,700. That could be titled as profit before interest and tax. What is our interest? What is our interest? Which workings did we do interest? The financial instrument, right? Workings what?
5.
How much?
1920.
So take it out and give me profit before tax.
614.
The interest is the loan note interest. You have to bring it.
Which loan note interest? This 1920, what kind of interest is it? Is it not the loan note interest?
Yes.
Or which other interest are you talking about, Emmanuel? You got it?
Distribution costs and administrative expenses.
Hey! Abo! So let's bring those guys up. So give me this. So this is what I can do. This is what I can do. This is what I can do. Yeah, Diego Bebre. And I'm gonna hear cosa. Give me total income more. 65.
5,000.
You are adding on. This investment income. So you want to add it to be what?
65,000.
65,000. So the fair value gain, fair value loss on the financial instrument. Most of your working sign?
5.
5. How much? Obi said 9, Obi said 5. 9. How much? 1,300. Take it out. Distribution cost. How much is it?
12,500.
It was in the trial balance, right?
Yes.
Then admin expense. We did an adjustment to it.
18,000.
18,000.
Yes.
Is that all, please? Yes, that's all. Now give me profit before interest and tax. 33,200. Then we bring the interest. Workings what?
5.
5.
That is 920, right? 1920. Take it out and give me profit before tax.
31,000.
290.
31,280. Then we bring the income tax. Workings what?
10.
10.
Yeah, but we have 2 9s. Otherwise, we would have 2 9s.
Do we have 2 9s?
Yeah, we have
Yes.
fair value loss on.
Income tax will be number 10.
So this is number 10.
Yes.
Okay. How much?
And
Is there? How much is it? 8,300.
300.
Take it out. And then this gives us what? The profits for the year. You see how cheap is it? But before you arrive there, you must go through all those things. Can you deduct for me, please? 22,908. So that is our profit for the year. Then we go to the other comprehensive what? Income. What do we bring in the other comprehensive income? What comes in the other comprehensive income?
Fair value gain.
Which fair value gain? Revaluation surplus.
Surplus or gain.
Workings 7. How much is it? 18,000. The total, right? Is that the only thing that comes in OCI in this question? Yes. So add the 18,000 to the 22,940. That gives us the total comprehensive income. How much do we have? 49,8. So this is our income statement and other comprehensive income. Any question, please? We are not saying you know, but
What about the deferred tax on revaluation?
we are not supposed to do deferred tax in this question. So assuming we're supposed to do deferred tax, then we would have done 20% on the 18,000, and that would have been brought here. In that case, that 20% of 18,000 would have also been included in this on this 1,000. I get the idea. So that's the concept. So that's my A. What is my B? For beautiful. Statement of changes in equity. What are the items that must be brought here? Share capital. Don't talk about share premium here. Did the company issue shares? In the trial balance, do we have share premium? So you don't bring it, okay? Then we go to retained earnings. And then what? Revaluation surplus. Oh, the worrying has started. And then we get a total. So let's go. Feed me up quickly. Opening balances. Go to the trial balance and let's catch it from there. Equity capital 60,000. Retained earnings. Retained earnings. 18,500. Revaluation surplus. Is there anything there?
No.
No, I mean the opening balance. There's nothing. When you add the two, it goes to total. Then we bring the profit for the year. What is our profit for the year? 22,980. That comes under retained earnings. And that goes under the total. What else do we bring here? Revaluation surplus. How much is it? 18,000. 18,000. Then remember the transfer. You got it. Workings what? Is it 7? How much was it?
1,000.
So we say we add it to retained earnings. Take it from where? Revaluation surplus. Are you following? Nothing will be here. But the company also paid dividends. Workings 6. How much dividend did we pay?
200.
That is also taken from where? The retained earnings. Is there any other item we've not spoken about? That's all right. So give me the closing balance. This is what goes to the statement of financial position. So balance brought down 60,000, 17,000, and then give me for retained earnings.
What balance brought not carry on? Carry forward.
Yeah, we can do carry forward, we can do brought down, it's the same thing. We could do brought down, we could do carry forward, it's the same thing. What will be my retained earnings, please? 23,280. So you work at the totals as well and get a total. So this one will go to the equity in the statement of financial position. So put them down and let's go to the last aspect, the statement of financial position. And now I have opened the door for you. So the rest of the questions in the case, you're going to be solving them. Next week, we'll talk about cash flow statements. And then we'll do ratios. Then console will be the last one. believe everyone is done here.
The statement of changes, that one too has the 3 zeros at the top.
Yeah. But once we started and indicated we are working in thousands, if I just put dollars here, it's not an issue. Is it? Yes, I'm sure. That's why we indicated that we are working in thousands above. So once you put that 3 zeros there, you may not necessarily have to bring it at every point. So the examiner knows that everything else you are doing is in thousands. What was the total marks on this question? 25, right?
Yeah.
So this is quite involving. CA can take this question and remove 1 or 2 of the notes, and then it will be a 20-mark question, because CA will be 20-mark question. This is an ACCA question, that's why you see it. And ACCA questions are much better, much tougher than the ICA questions.
Much better.
Yeah. And open you up. When I say much better, like in terms of building your understanding, it is good to go into the ACCA because the questions are well structured. And CA pick ACCA questions, so that one is not a news.
There are people who set questions. They are not I see how it's set up.
Yeah.
Why would it be questions from someone?
They must
No, but
they must have it, not Quincy.
it's they don't pick the whole thing. That's why I said a question like this can be picked. Then they will change the name, remove some of the notes.
They must have.
Can change the figures.
So that is it. I think last 2 semesters, corporate reporting, the question that was there on consolidation was an ACCA question they picked, and there were some 2 notes that they didn't bring from the ACCA merchants, and that was it. Like full question like that, and we solved the question in class, and we also put it on YouTube like that, and that was it. So it was some of the students that said the question we solved is like it was there, and when we saw the question, it was the same thing, and that's it. So I go for ACCA questions a lot. Hardly will you see me solving any ICA questions because this is quite tough and it will be helpful. Is that? Yeah, the question bank. But the question banks you see there, they are all ACCA questions. They just change their names into Ghana cedis. Can we go?
That's why they are too difficult.
But it's good though. When you solve it like that, you understand.
And you go through a question bank with I'm discouraged.
You are discouraged. That's a who's seriously crying. No, you don't have to be discouraged. So if you say a footnote or something you can't treat, all you do is hook me up and then I can help you out as quick as possible. Because it is helpful to do that. Now let's go to the financial position, the statement of financial position. You know the things we're going to be bringing is going to be very cheap. You see how short we are taking to prepare the main statement and how long we took to do the workings. And the workings, if you understand the standards, like I said, you can finish as quick as possible. As quick as possible. So non-current assets. What do we have? Property, plants, and equipment. What was the land and building value?
57,000.
What's it?
57,000.
And now, equipment there.
42,500.
So we add the 2 up, and that gives us the land and building. You got it? Sorry, that will give us the property, plant, and equipment. What's my figure?
What if you separate them?
On the face of the financial statement, it will be right to write property, plant, and equipment. But if you separate it to no issue. What do I have?
99,500.
99,500. What else will come here? The equity assets. You remember? The equity investment assets. The new figure they gave us in the footnote. How much was it? 15,700. Is that all about our non-current assets? Yep. So add it up. And let's go to current assets. What we got?
115,200.
115,200. Current assets. Inventory. How much? In the trial balance.
24,800.
Trade receivables. Trade receivables.
28,500.
Bank or cash.
2,900.
Any other current assets in the question? Okay, oh, add it up. No. Add it up and give me an answer. 56,200. So add that to the non-current assets, and that gives us the total what? Assets. What do I have? 171,400. From the accounting equation, we say asset is equal to capital plus what? Liability. So after we finish with the assets, we come to equity and liability. So under equity and liability, we first bring what? Equity. So go to the statement of changes in equity and you feed me up. So share capital. How much is there? 60,000. The closing balances. Retained earnings. 23,280. And then machine. 17,000. So add it up to give us the total equity. What do I have?
100 to 80.
100 to 80. So after we deal with the equity, please follow me carefully here. We come to the liabilities.
So I was really wrong because we realized that these 120 we had it in the statement of changes in equity.
Yes. That is the same thing we are bringing, the individual items.
Bring the bulk figure here.
Oh no, mama. You wouldn't question stats, mama. On the face of the financial statement, share capital must be separate, the items must be separate. You can't bring them all. No pension stats, do you?
Not so very fast.
Into a shareholder, now you have equity. 128, 280. I said, President, I said, who the component?
Then you
What's there?
Oh, we say, oh, granny, one thing. We say, one thing, but you will say. So let's go. Current liability, non-current liabilities. What are the non-current liabilities here? Remember the loan notes. Workings what? Please go to your workings and feed me.
Working 4.
Workings 4. How much?
24,420.
24,420. Any other non-current liability?
yes.
What?
Deferred income.
Deferred income. You got it. Workings what?
Working 1.
How much is there?
800.
Any other non-current liabilities?
Deferred tax.
You got it. Workings what? Workings 10. How much? Any other non-current liability? Yo, they are more kind of meet you. Add for me. And then let's go to the non-current liabilities. Trade payables. Go to the trial balance. 36,700. Next, deferred income. Still workings 800. What else? The current tax. Workings 10. How much? 7,400. Any other current liabilities in the question? Or that is all? Okay, well, add it for me more. And let me see what I'll get. Who is adding for me? Where? Yes. 56. 26. 220. Then 44,900. So watch it. Equity plus this plus this. So that gives us total equity and liability. And it should be equal to this figure. If it's not equal, what do you?
171,400.
Oh, that's big figure. 171,100. So this is the answer to the question. So that is it about that. The cheap marks you could get here easily without thinking. It's inventory, receivable, bank, you get things for that free, no thinking. This thing will be free of charge. This one too is given in the footnotes, so it will also be free of charge. If you mess up in any of these items, then we will mess you up there. If the loan note you mess it up, you'll be messed up. Deferred tax, so that's it. So this is income statement, other comprehensive income, statement of changes in equity, and the statement of financial position. Like I said, I have now opened the door. The rest of the questions there, try your hands on them. And if you have any questions, you raise them up. So for those of you watching online, if you have any questions, you put it in the comment box if you are watching the aftermath of this video. And also, you can send me hi on Skype via Premium Educator, and we can get in touch. So, au revoir. Are you sure?